to Iron Financial. This is the only place you need to be to forge a stronger portfolio and cut right through the market weakness. Today, we are putting a true giant under the microscope, Intel. They've just dropped their latest earnings report, and honestly, the market is spinning, trying to figure out what it all means. So we're going to tear this report apart, piece by painful piece, to see if this company's foundation is built on solid rock or if it's just crumbling sand. We are not here for the hype, we are here for the hard numbers. Let's get to it. Exactly. And that really is the question, isn't it? It's what every single investor is trying to figure out right now. Because when you look at Intel, you're seeing two completely different stories fighting for the spotlight. Is this a legendary titan of industry? Yeah, it's been beaten down, but is it now getting ready for a massive AI-fueled comeback? Is this a genuine buying opportunity? Or is this a classic value trap? A falling knife that looks cheap for a very good reason, just luring in hopeful investors before the next leg down. The numbers from this quarter, they're going to be our evidence. We have to figure out if management is actually building something new and strong, or if they're just papering over the crack. Okay, let's just dive right into the evidence. And the first piece we've got to look at is the top line, revenue. We're looking at $13.7 billion. A year ago, it was $14.3 billion. That is a 4% decline. Now look, in a normal market, a 4% dip, that's a concern, sure. But in an industry that is being supercharged by AI demand, where Intel's competitors are posting massive double-digit growth, a 4% revenue decline, that isn't just a red flag, that is a blaring siren. This tells me Intel is either losing market share at a frightening pace, they're facing unbelievable pricing pressure, or it's both. Our very first stress test on this company is showing a significant fracture in its market position. And it gets worse. It gets worse when you move from the top line down to the bottom line. This number you're seeing, this is GAAP, Generally Accepted Accounting Principles. This is the official by-the-book number that the accountants sign off on, and it is a loss of 12 cents per share. Now, in the same quarter last year, they lost 3 cents, so the loss has literally quadrupled. On the surface, this company is not profitable, period. It is actively losing money for its shareholders according to the standard accounting rules we all have to follow. There is absolutely no way to spin this as a positive. You've got a negative top line and a negative bottom line. The initial evidence here, it's bleak. Whoa, hold on a second. Before we move on, let's talk about the guidance, because this number right here, this is what absolutely shook the market. This is the number that makes you just stop and ask, what in the world is going on here? Their outlook for the next quarter, for Q1 2026, is for 0 cents of non-GAAP earnings per share. And you have to remember, non-GAAP is supposed to be the favorable number. It's the one management wants you to look at after they've pulled out all the bad stuff to make things look better. They are telling the entire world that even on their own best terms, they expect to just break even. For a company of Intel's massive scale and history, guiding to flatlining profitability, that is a massive warning signal. How does a titan like this grind to a complete halt? You have to ask, is the engine just seizing up? To answer that very question, we've got a clear plan of attack. First, we're going to put Intel on trial. Then we'll start deconstructing the damage in their accounting and expose what I'm calling the margin meltdown. After that, we'll see if there's any hope. In what looks like a tale of two Intels, we'll read the CEO's playbook, and finally, we'll deliver the iron verdict. Let's get into it. The headlines are screaming right now, and honestly for good reason. A shrinking top line, a GAAP loss, and a forward guidance of 0? It's bad. But, headlines don't tell the whole story. We need to dig deeper. We need to figure out if all this negativity is just surface-level rubble from a messy but necessary construction site, or if the entire foundation of this company is rotten. Is there a solid structure actually being built underneath all this noise that's going to support future growth? That's what we need to find out. All right, so let's start with the numbers themselves. To really understand Intel's health, we have to dissect the difference between their official GAAP results, the numbers they have to report, and the non-GAAP story that management wants you to believe. And look, this isn't just some academic exercise. This is about understanding the narrative they're trying to build and whether or not that narrative is structurally sound. This is where we look for the truth behind the accounting. Now, what's really fascinating about this slide is the incredible contrast it shows. Just look at net income. On a GAAP basis, by the rules, it's a loss of $600 million. But then you switch over to their non-GAAP number, and suddenly it's a profit of $800 million. Same thing for earnings per share. A 12-cent loss magically becomes a 15-cent gain. That's a $1.4 billion swing. They get there by excluding things like share-based compensation for their executives and acquisition-related charges. But Is this real or is it just financial engineering? It feels a lot like they're saying, hey, look, if you just ignore a whole bunch of our very real, very expensive costs, we're actually profitable. I mean, share-based compensation's a real expense. It dilutes every other shareholder. Acquisition charges are real. They actually spent that money. Are we as investors supposed to just pretend those costs don't exist to make the story look better? To me, this looks less like providing clarity and a lot more like a magic trick to make a really bad situation look acceptable. That's the classic skeptic's take, and it's a completely valid one. You have to question this stuff. But let me try to frame it from management's perspective for a second. The argument they're making is that these costs aren't part of the day-to-day operations. Think of it like this. If you own a house and you sell your old car for a one-time gain, that doesn't mean your annual salary went up, right? Non-GAAP is trying to show you just the salary of the business, its core operational profitability, without the one-time events. So while you're absolutely right to be skeptical, it is a tool analysts use to gauge underlying performance. The real danger, though, is when a company starts to rely on it too heavily to mask fundamental, ongoing problems. But here's the thing. Whether you look at GAAP or non-GAAP, you just cannot escape the biggest problem of all. This is the most critical stress point in Intel's entire structure. It's the number that tells you if they have any real power left in the market, their gross margin. This is the percentage of revenue they have left after paying for the cost of actually making their product. Historically, Intel had fortress-like margins. I mean, it was their crown jewel, their competitive moat. But recently, that fortress has been under a brutal siege. This is where the pressure from competitors like AMD and NVIDIA becomes painfully, undeniably visible. This chart tells a truly brutal story. Just look at the crater right there in the middle, in Q2 of 2025, where their margins completely collapsed to a terrifying 27.5%. For a company like Intel, that is a catastrophic drop. Now, they've managed to claw their way back to 36.1% this quarter, but look, they are still well below where they were just 1 year ago. This is not a stable foundation. This is a chart showing extreme volatility in a structure that nearly broke in half just 6 months ago. The recovery is only partial, which points to a major, ongoing structural weakness in their business. And it's about to get weaker. They are telling us, right here in their own guidance, that the margin is going to fall again next quarter, all the way down to 32.3%. So that little partial recovery we just saw on the chart, it's already reversing course. What does this mean? To me, it means their pricing power is gone. It's evaporated. It means they are in an absolute dogfight with their competitors, and they're being forced to slash prices just to move their product. Think about it. They're spending billions upon billions on new factories and new technology, but if they can't sell the chips they make at a healthy profit, what is the point? This does not look like a temporary dip. This looks like a race to the bottom, and right now, it's a race that Intel is losing. You are absolutely right to point out the extreme pressure on margins. It is, without a doubt, the single biggest risk facing this company. However, if we pivot our analysis for a moment and look inside the company, past those consolidated headline numbers, a very different story actually starts to emerge. This is what the bulls, the believers in Intel, are hanging their hats on. The argument is that the overall company performance is being dragged down by an old legacy business, while a new, much stronger Intel is being forged within the individual business segments. You have to look at the component parts to see the new foundation being laid. So the crucial point is right here, on this slide. This is the entire core of the bull case. Look at the top line, Client Computing Group, or CCG. That's their old-school PC chip business. It's a massive $8.2 billion business, and it's shrinking by 7%. It is a drag on the whole company. But now, look below that. Data center and AI, the business that goes head-to-head with NVIDIA, it grew 9% to $4.7 billion. And Intel Foundry, their brand-new initiative to manufacture chips for other companies, grew 4% to $4.5 billion. This is the hard evidence that the turnaround strategy isn't just talk. It actually has legs. The future-facing businesses are, in fact, growing. Okay, I see the green shoots, I do. But I also see the giant dying tree that's blocking out all the sunlight. Let's be perfectly clear here. You add the two so-called growth engines together, data center and foundry, and you get $9.2 billion in revenue. That one shrinking legacy business, client computing, is $8.2 billion all by itself. They're almost the same size. So what you have is this massive anchor of a business that is actively shrinking and two growth businesses that are growing at pretty tame single digits. Is that growth really strong enough to bear the weight of the decline? It feels like they're trying to fill a bucket that has a massive hole in it using a teaspoon. The new growth needs to be much, much stronger to offset this legacy decay. That's a fair challenge. The math has to work. And you're right, the growth does need to accelerate. So let's turn from the hard numbers to the narrative. What is management actually telling us? Is their strategic blueprint credible? Is it a realistic plan for the future, or is it just corporate rhetoric? The kind of talk designed to calm down nervous investors while the house is on fire. The CEO's words are the supposed blueprint for this new foundation, so we need to examine them very, very closely. Okay, so here it is. This is the cornerstone of the CEO's turnaround plan. He's making a very bold, and I'd say contrarian bet here. While the entire world is obsessed with NVIDIA's GPUs, he's doubling down on what Intel has always done best, CPUs. And he's arguing that they are the essential backbone of the AI era. The argument is that every AI server, every single AI workload, still needs a powerful central processing unit to manage everything else. The challenge, of course, is convincing a market that currently sees GPUs as the only game in town. He's also highlighting their progress on manufacturing, specifically Intel 18A, as proof that they are executing on the plan. This is the vision, a new Intel built on advanced manufacturing and the centrality of the CPU. And right on cue, just as the CEO gives us that grand vision, here comes the CFO with the excuse. We exceeded Q4 expectations while we navigated industry-wide supply shortages. Wait a minute. First of all, are we celebrating beating expectations that were probably lowered to begin with? And second, is supply shortages a legitimate reason, or is it a convenient scapegoat for what might be weak demand or just poor execution? I mean, in a market where Intel's competitors seem to be finding all the supply they need to post massive, record-breaking growth, blaming shortages just feels weak. It raises the question, is the problem that they can't get enough parts, or is it that customers just don't want the parts they're making as much as they used to? This statement doesn't build my confidence, it just raises more questions about their ability to execute. So we have the CEO's grand vision on one hand, and we have the CFO's questionable excuses on the other. It is time to weigh all the evidence. The trial is coming to a close. We are going to lay out the bull and the bear cases, side by side based on everything we have just presented. This is where we weigh the potential for a solid new foundation against the very visible, very deep cracks in the current structure. All right, the bull case, the argument that this structure is being built to last, it rests on a few key pillars. First, there is undeniable growth in the businesses that actually matter for the future. Data center and AI are up 9%, foundry is up 4%. The new foundation is being poured. Second, management has a clear, articulated plan. It's centered on manufacturing leadership with Intel 18A and positioning the CPU as a critical component of the AI ecosystem. And finally, if you use their non-GAAP metrics, you can make the argument that there is an underlying profitable business and that the turnaround is in fact working. But the bear case points to deep structural cracks in that armor. First and foremost, the gross margin compression is severe, and the company is telling us it's going to get even worse. That is a 5-alarm fire. Second, that legacy PC business is enormous, and it's shrinking, acting as a dead weight on the entire company. Third, that Q1 guidance of 0 non-GAAP earnings is a shocking admission of weakness. And finally, the entire profitability story relies very heavily on you, the investor, ignoring very real costs through their non-GAAP accounting. The cracks are not superficial, they run deep, right through the core of the business. So there you have it. The evidence is laid bare. On one side, you have the promise of a new foundation, you've got real growth in key areas, and a clear strategic plan. On the other side, you have the harsh reality of collapsing margins, a shrinking core business, and frankly, alarming forward guidance. So we leave you with a final question, the one you must answer for your own portfolio. Is Intel successfully forging a new, stronger structure for the AI era? Or are these numbers and all this narrative just wallpaper, hiding structural cracks that are simply too deep to repair? The decision is yours. Thanks for joining us at Iron Financial.